And our next guest, who's now at the table, says the last mile in the Fed's inflation fight could prove to be more complicated than the market expects. Joining us right now is Mohamed El-Erian, Chief Economic Advisor at Allianz and President of Queen's College, Cambridge. I want to talk about this idea that it's actually going to be harder because in many ways the market, and I think so many actually Fed heads and other people around the Fed would say it's easier. Now that actually inflation has come down, this last sort of piece of the puzzle, there's a lot more flexibility in terms of when you raise, when you lower, what you do, whereas before was actually the hard part.
So there's two different issues. One is what do the inflation dynamics look like? And two, the policy dynamics. The assumption in the marketplace is that inflation will continue to go down, right, and that we're going to have core well-behaved. Headline may pop up for a little bit, but it will come down. And importantly for policy, that means the pause in September becomes the end of the hiking cycle, and we cut rates next year.
Right.
That's what the market thinks. What I think is going to happen is headlines going to prove much more complicated. Already you've seen people push up their month-on-month projections of headline all the way up to 0.6, 0.7. I think core inflation will be well less behaved, and then the Fed at the end of the year is going to have a choice. Do we live with 3% plus inflation, or do we crush the economy?
Well, and then the question, though, that I'd ask is how quickly you think they need to get to 2, right? I don't think they're changing 2. 2, I think, is hard. But the question is whether 2 is in 12 months from now, 2 is in 24 months from now. I mean, and whether they really are prepared to crush the economy. I'm not so sure.
So I hope they don't crush the economy. It wouldn't be a good thing to do. I think we can live with inflation above 2% as long as it's stable. Don't forget, 2 is completely arbitrary. Now, I understand the Fed not wanting to talk about it, but you have more and more economists willing to talk about it, saying, you know what, I'm not sure if we set the inflation target today, it would be 2. What I think is going to end up happening, Andrew, is exactly what you said. They're going to push 2 out more and more and more. We're going to live with higher than 2, and at some point down the road, we're going to make that transition. But we're not going to get an announcement of a different inflation target anytime soon.
And is your sense that they would, I mean, right now you think it's a pause. I mean, the market thinks it's a pause. And then the question is, are they going to lower rates later? Do you think there's a possibility of just one hike somewhere in between? And what would the market do if, and by the way, would the market have a heart attack if that was the case?
The market shouldn't have a heart attack. But what the market should recognize is we're high for longer.
I was going to say, if they don't lower rates at the beginning of next year, the first half of next year, does the market react poorly, the stock market?
I think the market will have to absorb this notion that we're high for longer. What we don't know, and there's a massive debate going on about monetary policy, is it the level or is it the rate of change? Have we seen most of the long and variable lags, or have we not seen most of the long and variable lags? So there are real questions about the design, the conduct, and the effectiveness of monetary policy that the marketplace right now is not absorbing. The marketplace assumes that the Fed is going to be able to cut rates early next year. I don't think that's going to happen.
Okay, in the meantime, you have other things that are taking place. Yesterday, Jamie Dimon was railing against the new capital requirements for banks, saying that that's going to slow things down in a big way, the amount of lending that banks can and will do as a result, and that will have an impact on the economy. Do you worry about that?
I do. I think Jamie is absolutely right in saying that higher capital requirements is not the answer to what happened in March and April. March and April was a problem of supervision, that the problem was identified, but nothing was done to force these banks to deal with the maturity mismatches. To then react and increase capital yet again is not the right policy response. And there was a risk that that will not just lower credit, but push it into the non-bank segment. And that segment is well less supervised and regulated.